We were just asking some people what were they expecting from today. We can get started, and if anyone wants to jump in at any point, don't feel bad to just raise your hand, ask questions. This is supposed to be a learning experience, and it's going to be a wild ride for an hour. We've got an exciting case that we've teed up for you to see very practically how you can fit it in with some of your clients and what it can mean for you as a professional in a distress situation to be more relevant. So let's jump in and get started. I must share my screen. There we go. So more people may be joining, and that's fine. So Ravinia Capital, Tom and I on the call. Tom always calls this the investment bank in the heart of the middle market. And here you see some of the deals we've closed recently. Some of these are really hairy deals that people on the street were saying these deals cannot get done, and we got them done. But some of these are also healthy deals where we've really gotten very top valuations for companies. So, Tom, anything you wanted to add of where your firm is at this point?
Yeah, I just think, as attorneys, and my background is law originally, but we set up the firm really to be an advocate for the clients and to help them, figure out what's the best course. And sometimes it's going to be involved in a bankruptcy and we can run the sale, but a lot of times they're looking for other options, so we put ourselves in the shoes of the owner and use all the resources we can. If it was me, what would I do? And so if we can come up with cash, they don't want to sell, and so the best thing a lot of times is to find cash within the business and to provide a runway. And the 13-week cash flow is a tool we use all the time. And it gets everybody on the same page. It's a real tool. Everybody's used to accrual accounting, and accrual accounting really is not sufficient and can be misleading in these type of situations. So Kobus is a great practitioner and very advanced in the 13-week cash flow. It's good for all of you to know, and something, to make sure your clients are looking at things, but you really can understand what's really at stake. Do you have cash to get through it? And Kobus can help find cash. So it provides an extra solution and something that you can provide to your clients. Will help to understand these things so you can kind of be even more helpful than you might otherwise be. So I'll turn it over to Kobus.
Great. Thank you, Tom. And so Tom just explained his background is in accounting and law, but he also has experience running companies in the past. And I'm a mechanical engineer by background. I'm a internationally recognized black belt in continuous improvement. And I've been running either as a coach, a third party to an underperforming company, come in as a coach on a 100% profit sharing basis, helping a company to make more EBITDA. Or since 2003, I've been interim CEO where I will be in charge of a business. And I've learned from both parts. How can you affect the company as the CEO, but also how can you affect it if you're not in charge, which is sometimes much harder, especially in a distressed situation. So hopefully I can share some of those insights during our time together today. Just a note, on the phone or on the workshop today will be the TMA's Education Committee. They are monitoring this workshop for possible inclusion. They have an existing 13-week cash flow, which is run by Larry Fox of Huron. And this advanced 13-week will give a more practical view of how do you turn red ink into black ink, and how do you use the tools that turnaround practitioners typically use. So also on the call today is some of my friends from around the world. I see Robert Bolton, he's from Australia. Hi, Robert, good to have you on the call. and Leo Laurama from Finland is on. So I've worked with the TMA in different countries, Southern Africa, the turnaround community in Hong Kong, Australia, and different parts of the world, also in Canada, and of course here in the US. And it's really good to see international attendance for this workshop today. So here's our outline today. We are going to see, from an attorney and legal point of view, how can you use the 13-week cash flow to be more relevant, to know the scope of advice that helps bring you to clients in specific situations. Maybe get a better understanding of why a large cash flow change is often possible in a short amount of time. We'll go into that. Understand the sequence of actions that must be taken to overcome certain obstacles, and then have some quick test indicators for you to ask those probing questions to open a conversation that makes you relevant in a certain situation. So to do this, we're going to look at a sample company. This is a widget company. I don't want to make it too specific. It can also be a non-product company. So a large law firm or a large accounting firm, even a development firm that does software can go through this process. Some of the techniques are inventory related, but some of them are really generic. So this sample company has 192 million in revenue. It's a multi-location. They supply an OEM customer. Their margins are 22%, and they have an asset-based line of credit where they get an advance of 50% on inventory and 75% on accounts receivable. Pretty standard. I know the asset-based loan is very conservative. Where we are in the credit cycle, competitors in this space are pushing these covenants or ratios much higher at the moment. But just to be conservative, we're going to use these metrics. And so what we're going to simulate here is a real crisis. We don't want to show a middle-of-the-road case. We want to show what is possible in some of these extreme cases. So we're going to simulate a 60% decline in sales. Now that's extreme. It's more than half of the business of the company is gone overnight. And this is quite realistic. Ravinia has worked with one client last year, helping them negotiate with their bank, where from February to March and the rest of 2020, 80% of their business was just gone. They had 20% left. So that company is still going, and you do see these situations, and we want to show what difference can you make with the various techniques in these situations. So our company, I'm going to go to the model next. We're going to start with a small loss already, 1.9 million. Not large in relation to the size of the company, but then after the event, after the decline in sales, we'll show that we go to a big loss situation, which get the lender to put them on hold, and the lender is requesting an investment bank to get in some more capital, and we have to show what options are available. So if we look at our model, and I sent out the email today again with a slightly updated model. These models look different. You may have seen ones from banks or ones from other consultants that look slightly different. The main thing is we are looking 13 weeks, and we had the question, why 13 weeks? 13 weeks is 1 quarter of the year, and 1 quarter gives that visibility of what can be done in the short term. And like Tom is saying, here we're not dealing with accrual accounting. We are just dealing with cash flow. We are, all of these numbers, and we will go through it in some detail, will mean that the timing of cash hitting our bank account, which also hits our borrowing base. And we'll go through those details in a minute. So
just to reemphasize, the reason also that this is used as opposed to other finance is that it can't be so bullshitted. It's the real thing. And so what happens with accrual accounting, people fall in to think it's real. They have like cost accounting. So when they have inventory, they apply, for instance, overhead costs to that, or they book sales that haven't happened. There's no fluffing in the cash flow. So it's real stuff, so that you're getting to the truth, which is what you need in these distress situations. And you don't have to parcel, if there's some movement in accrual accounting or estimates.
Right, correct. So what you see here are the different categories. Normally on top of a cash flow, you will have your total receipts. I'm only showing customer payments, but they can also be equity infusions, tax refunds that you can put in here. Then you have a section of your operating costs. Most of that is your accounts payable to your vendors, especially if it's an operating or a product company. And then your next largest item is normally your wages. And you will see how we use the timing here. This company pays their wages every 2 weeks, which is very typical in the US. And then there are the other costs like travel, and this company leases all of their buildings for each location. They have insurance like any company and other expenses. So we're taking a very complex financial statement and we're making it really simple by doing it like this. And then we also have another category of investing and financing related expenses, which we like to see separate. And that can include CapEx, interest payments, bank fees, and restructuring expenses. So once we then look at that, we get our yellow line, which is the weekly cash flow. This is our positive or negative cash flow for every week. And that gives us this amount that I mentioned, the 1.9 million that we start with for our little journey today. So now to simulate the sales decrease, we're just going to go and take our customer payments to 40%, so 60% is gone. And immediately you will see this model will give you how much further you are in the hole. So now we've got a $10 million cash problem. And not only that, this model also has a borrowing base. So what you see here is a cash beginning balance of $3.6 million. And then a revolver balance. The revolver is typically a number that the bank shows for your borrowing base. And in this case, we mentioned the company has 75% advance on accounts receivable, which gives them the 6.7 million here. And they get 50% advance on their inventory, which gives them 28 million here. Their inventory is just below 60 million. And if you look at this size of company, that gives them 2.5 turns of inventory, which is on the poor side, but it's quite realistic. And that gives them a total borrowing base of 35. So in this case, you see that all of a sudden, let's put that back to 100. When we started, this borrowing base was looking, there was room in the borrowing base, 2.5 million, no problem. There were some problems later on, but now all of a sudden this company is in, they may be busting some covenants on their asset-based loan. They may be approaching you as their legal advisors on what to do. And this tool just brings a great conversation on the table to say, what are all the options and what should you be doing? So the way that we use this, I just want to show where some of these numbers come from. The customer payments, in this model, we have an accounts receivable tab. So here you can put your customer invoices with their terms, and the model will just put them in the collectible weekly buckets where they're going to be collected. And that flows into an intermediary sheet, which shows all of our existing accounts receivable, invoices that we expect to be paid in the next 5-6 weeks. And then also it then gradually starts to project future accounts receivable, which we don't have in invoices yet, but we expect sales to continue, even if it's at a much lower pace. The same we have for accounts payable for our vendors and our trade payables. We have all of our vendor invoices here, all the existing ones, and that puts it in the different buckets based on their payment terms, and that flows into the same intermediary sheet here. So here are your existing accounts payable and your projected future accounts payable. And those are the main pieces that affect our cash flows, and that's what we see here. We also have a payroll tab, which we will touch on later, where we will see there's a corporate division, a division 1 with all of their plant personnel on the one line, and a division 2 with the same plant people summarized on one line, so that you can have the monthly payroll amounts that we are projecting in that main sheet. So that makes a very complex situation a good summary of that so that you can have that discussion. But now we're going to look at different scenarios, different techniques. So we're going to use 3 standard techniques and 2 advanced techniques. So some of the opportunities we are not going to be considering is real estate. It's often possible to sell real estate or do a sale and lease back. Salary reductions are often possible where you voluntarily get the people to take less money for a period of time, like people did in 2009. Facility consolidations are possible. A detailed expense line reduction, like you can look at the company's freight expense line and really see how well they bid that out and what the room for improvement there is in that. We're not considering that, and any excess inventory auctions or reductions are not considered. So what we are going to consider is we start with a simple opportunity. This one we all know has been very relevant. The second PPP loans are now available here in the US. So other countries like Australia and Finland will be doing some other programs, but just bear with me here. These locations for our sample company each have less than 300 people, and as long as they have their own tax number or EIN, they do qualify for this program, and they must also show a 25% gross receipt reduction from the corresponding quarter last year or the year before to qualify, which they do. And the maximum loan is $2 million, which you'll see is a little bit of a problem for our sample company. So if we put that in our model, just so that you can see how we navigate this, you'll see there are 5 tabs at the bottom here, 01 to 05. That's opportunity 1 to 5. And if we go to our first opportunity for the PPP loan, we're going to assume this company has a really sharp CFO. They put in their application early when this program started, and their money is expected in week 2. So that $2 million comes in week 2. And then we have our interest to pay monthly, which we project on our disbursement side for a net of 1997. So now if we come to our main 13-week cash flow sheet, you will see we have a section in the model where all of the opportunities are listed. And if we just go here and we switch that one on by turning the 0 to a 1, here our scenario flows in. So now we can, with the management team in a room and this on a screen, you can do what-if scenarios with them and say, show me what it looks like with this option, without the option. If we make that option double the size, in this case you can, but for some of these others you can. And you can really have a very condensed and high-value conversation with this tool that guides you. So that is one opportunity. Any questions on that before we move on? I'm going fast through some of these opportunities because they're quite standard, but I do want to cover them, and then we spend a little bit more time with some of our advanced ones. So our second opportunity, well, the point I forgot to make was We were in a hole of almost $10 million, and now by doing this opportunity, we have moved to a hole of only 7.7 million. So this PPP loan doesn't help this company enough. We need much more help. So the company may think, whoa, there's no way that we can avoid a bankruptcy here. This will have to go into some kind of orderly process, but we have some more opportunities to pursue. So if we look at our second opportunity is price increases. The clients, your clients will probably tell you, don't even try that because our customers will just walk away. They have other options. But every turnaround manager knows that once you do these price increases correctly, by far most of your customers accept them if you do it in the proper way. So you want to do it with some kind of a third-party validation, like this chart of hot rolled steel prices, which recently went up from $500 to $1,000. This gives the client the idea of your problem, and they will be aware of this. But then you say, we are only asking you for a small change of between 4 and 9%. So that makes it much more probable that they will pass this increase for you. And you also have to consider your success rate of how many customers you need to agree to this for this to be worth your while. So if you go to opportunity 2 in our cash flow model, here you will see, remember, now we are planning a 13-week cash flow. We don't know which customer are going to tell us to take a hike and which are going to accept it, or we might be able to negotiate some numbers. So we are assuming 8% from customer 1, 4%. This is a tough customer. We only can get 4%, 9% here. And this is the percentage of sales that each of them represent. So together, that's 45% of sales. And we cannot expect this in week 1 because of our accounts payable terms that we have in place. So the earliest we can expect this to hit our bank account is week 4. And this is how we do this. On the disbursement side, it's normally very good to also project a loss of business. So sometimes you do get a 2% or a 5% reduction of revenue from a client. But in this case, because we have such a big 60% reduction already, I did not put them in because the size of this opportunity, as you can see, is small to start off with. So we only have 447, and if we come to our main sheet and we activate this guy, that flows in, and we see now we are in a hole of 7.3 million. So we're getting better, but much too slow. But now we can have that conversation in a boardroom and say, what if we double the increase to the customers? More of them may walk away, but you can clearly see it's not worth spending your effort there because it's such a small amount. Sometimes it's not this small. Sometimes what is happening in your industry is so extreme that you are forced to do a 20% increase, and you just have to stay with that. But in this case, we're just demonstrating it with the numbers that we chose. And we see that much more improvement is needed. So our third opportunity is the last standard one. It's workforce reduction. Now, if you as a company owner have such a big disruption in your industry and you come to your lender and you say, well, I need you to borrow me more money and I'm not going to cut any of my people, that's not going to fly. So you have to make this part of the solution. And we know it's a very sensitive topic. In the US, in Illinois, but also in many US states, the WARN Act requires us to give 60-day notice for layoffs larger than 50 people. So what we are able to do with the sample company is to do layoffs of 49 people per location, because they are separate tax entities. And then we also have a second layoff plan because at the same time we're giving notice on the WARN Act on more layoffs to follow. And then that gives us time to see exactly what that second number should be with some of the improvement plans that I'll be showing in a minute. We should note that the layoffs may impact the forgiveness of this PPP loan, but at 1%, you're not going to get many people giving you money at 1% in these extreme times. So it's probably good to take that PPP money and see if you can get the largest percentage of it forgiven, and maybe you'll have to pay some of it back. We're also going to consider severance and accrued vacation of 4 weeks for each of the 2 layoffs. And if I put that in our model on the opportunity 3, you'll see it looks like this. We have a corporate division, and that reads from that payroll tab that I showed you, division 1 and a division 2. And we cannot get a reduction in the first couple of weeks, because if you look at the timing in the 13-week cash flow, our payroll is funded in 2 weeks' time. And that's basically next week. So the week that we are in is already, people have already worked the money that they're going to be paid next week. So the fastest that you can typically do this is 2 payrolls from your planning date. Maybe your timing works that you can do it here, but we're being conservative. So we say, here's your first payroll reduction of $250,000 but you're going to have offsetting costs. You're going to have to pay severance and accrued vacation of about $500,000 for a net negative. 2 weeks later, you break even, and it becomes a cash positive initiative after your third payroll. And here on the 10th week, we have our second layoff scheduled. Again, more money out than money in, but a good payoff later on. So you see that the opportunity here is 745. And if we bring that into our model by putting that one to 1, we see, well, now we're at 6.5 in the red. We are climbing out of our cash hole, but too slow. So now we can say, can we cut double? We know we can't cut double on round 1, but we could make a much deeper layoff on the second round, and those conversations can be had. But let's look at some of the other opportunities, because we want to focus our attention where it's going to be the biggest bang for our buck from an effort and a preservation of knowledge point of view, because the deeper we cut with our people, the more knowledge we lose. So opportunity 4 is called inventory reduction. And you see that this sample company has a large amount of inventory, 60 million. So that already gives you an idea of the opportunity here. That's cash that the company committed to, that is sitting on. Some of it is already paid for. Some of it you still owe the vendors, but that is the opportunity. And on the right-hand side, you will see that 75% about is in inventory, or is advanced from inventory on your borrowing base, and 25% of your borrowing base is advanced from accounts receivable. The popular misconception companies have is, if I reduce my inventory because it's this blue section, it is most of my borrowing base, I'm going to bust my covenants. I'm going to lose my availability from my line of credit. And we have to always remind our clients that $1 in inventory, you get 50 cents for that in your borrowing base, 50% advance rate. Once you sell that $1 of inventory, you get 46 cents more. Now it's 96 cents because of the 75% accounts receivable and the markup that you then bring into play. And then once you collect that accounts receivable, you get $1.27. So if you can imagine an end cap or some item that this company produce, it will be $1 in inventory or 50 cents in the borrowing base, 96 cents once you ship it, and $1.28 when you collect it. So that's important to understand because you get the buy-in much better.
I'll just add that, you're going to find your clients a lot of times are going to be reluctant to, they might be dying for cash, but they're reluctant if they have, like, let's say a slew of inventory that's all obsolete from 5 years ago, and it's in the borrowing base at like 60 cents, and they can only get 20 cents for it. So it totally makes sense. You need the cash, but they think it's going to make it worse on their loan. It kind of goes to, having transparent and good communication with the lender. So I think, because it's in everybody's interest to do it. But if you do it and don't kind of inform everybody, but, this is something, again, the 13-week cash flow can be a really good document for you to work with your clients to really kind of get to what's really going on and what really matters.
Right. And now just a quick rule of thumb before we dig into how we realize this opportunity. Inventory turns is an important rule of thumb, but you must do it on the right basis. Some companies cheat and they use sales on inventory, which makes it look a little bit better, but you should use your cost of goods sold divided by your inventory, which gives you your real turns. And a good turns is 6 times. If you can turn your inventory 6 times, that means it's on average 60 days. That's pretty good. I've seen 8, 10. I haven't seen 12 many times. That will mean an average of 30 days of inventory. That's world class. But poor inventory turns are less than 3 times. So now, just a moment. Now we will look at the multi-location inventory simulation. This is a very busy sheet, so don't be concerned about all the numbers. I just want to make a larger point about how we do this. When you come to a company and you, as an outsider, are telling a company you think they can improve, it is really, they know their inventory so well. It's a hard ask for them to trust you. They normally think they know it better than you. So what we typically do is we ask for a copy of their data and we calculate the demand per week, which they typically do wrong, and we help them to get it right. And then once we have that, we can simulate just by using the automatic flows of the different items at the moment. We let that flow through this model, and we show that any location, this location in this example had $4.3 million. In 7 weeks, if you just allow the items to flow at their normal pace, this will come to 2.9 million, a big difference. And that difference is converting into cash as you do this. So that's the big mechanism behind this. We can adjust the demand per week based on the 60% drop, and it will not be the same for all different items. Here you see some of these items are raw materials, some of them are finished goods, and you have to, the different product classes will have different reductions. But this makes it really tangible for a company that I say, okay, I see you know something that you can bring to our company that adds value. This is a summary that we did for a NASDAQ-listed company, Swisher Hygiene. They were going to implode without cash. We got them cash positive, and we won the Turnaround of the Year award for that. And this shows how fast this method works. Most of your gain is in the first 13 weeks, and that's what makes it such an excellent tool. It's not like the payroll example or the layoff example or the price increases that you must wait for a long time for it to happen. A lot of this happens very fast. In day one, we can come in, we can do training, and we can start putting this in place in a real crisis situation. So in this case, we identified from 15.6 million, they could reduce to 7.2 for more than 50% reduction. So the mechanism for how we make this work is we typically show the companies, and this is something they don't typically see themselves. Their ERP systems hide it very well. We have worked with SAP and many different ERP companies on trying to improve, but they still do it horribly. They do not show companies the improvement opportunities as they should. So here you're seeing over time, our one item, this is a detergent, and on the left-hand side, you have the quantity on hand. So you will see this detergent has 3,000 in stock, and the customers use it, and then they replenish when there's about 2,000, and they continue to replenish very early, and they never really use their safety stock. Their safety stock is huge. So if you apply world-class principles, this is the brown section, you can take this company really close to the zero line and just oscillate at the bottom. And then you show them the numbers. They used to have 5 weeks on hand, and you can basically oscillate them around half a week of usage. And we do this with a buffer mechanism that is explained into this 2-hour video. So it's an internationally recognized technique. All of the lean and continuous improvement people will know these techniques. It's just making the company aware, how do they put this mechanism in place? And like I said, you can do this within days. It is not a long process if you have the right coach to guide the team. So now we're going to put it in the model, and we're going to assume an even reduction rate. I'm not going to use that accelerated rate, so I'm being conservative. And we're also going to reduce the sales by the 60% that we said the company is experiencing in the industry. And the results are based on our past results. We've actually seen these results and obtained them for customers. So we're not showing you something that is not grounded in reality. So if we come to our 13-week cash flow model, and we look at opportunity 4, here you see your inventory, 60 million. And here at the bottom, we put in our inventory simulation. So this will have the percentage decrease by week that's possible from your simulation. And now you reduce that by the 60% that the market has fallen. And we just take the average so that otherwise we will have to, maybe we're being a little bit too aggressive that way, and we're just being conservative by taking an average here. So that gives us this number. This is the number that your accounts payable will now decrease. So within week 2, your accounts payable will be decreasing already because you will be shipping product to your customers, but you won't be buying new product from your vendors. You are shipping most of it, by far the most of it, from inventory. But it's not hitting your cash, your bank statements on week 2. You have to wait for 6 weeks, in this case, the payment terms on your vendor, so it will be hitting your bank on week 6. Still, look at these numbers. They are big numbers because we are affecting the main product flow of the company, and this results in a 6.5 million opportunity that we can get from week 6 forward, affecting our short-term cash flow. So if we put that in our opportunity, that flows in. And now, for the 13 weeks, we are positive. It looks like we can make it. We can avoid a bankruptcy. But it's not the whole story. Our borrowing base is still underwater. You can see at 10 million, and that is your big problem. Because your borrowing base, which means your accounts receivable, that's the amount of invoices payable, that reduces very fast because of the sales decline. So your borrowing base itself is getting smaller, and your inventory is getting smaller because you are shipping it and you're not replenishing it. So you have to allow for that. And the way that we do that is, and I make the comment here, beware of funerals versus turnarounds. I have this certified turnaround professional friend that talks to me all the time. He says, most of my turnarounds end up in funerals. What do you do different? And the key here is to remember that if you just stop paying, this line here is the accounts payable that is pushed out. That means if you just stop paying vendors, which is a normal thing for even a professional, they come to a situation, they see the borrowing base is 10 million in the red, they say, well, what are you going to do? Just stop paying people. And then that results in a funeral. But if you can do it on a clever basis and you take from your top vendor down and you sit with them and you say, I have a lot in inventory, so I'm going to be shipping my inventory, but these 4 parts I need from you in the next 6 weeks. And in return for that, I'm going to pay you this amount of money, and you make a dollar-on-dollar deal with each vendor. And that's what we've been able to do. Sometimes you have to give them $1.50 for every new dollar that they ship you. Sometimes they will say, go pound sand, and then you have to find an alternate vendor. But doing it that way, you are able to push out 80% of your accounts payable. And that is a really big number. And
I just want to add, for the attorneys too, that this issue with the payables, and this is another area that the cash flow, when you get into a bankruptcy, you're going to be needing to show who are critical vendors. And also when you're dealing with your lender here, and again, there should be clear communication between your clients and the lenders, or you may be representing the lenders. But they're going to be looking at any payment to the vendors as being taking away from their collateral, because they're in a higher priority. And if it goes to a bankruptcy, they're secured and they'll get paid first, and these are unsecured. So they don't like to see routine payments. So if you can show that you're really managing it through the cash flow, and like Kobus said, it's a mistake to say, oh, we're just pushing everybody back 30 days or 60 days. Or I've seen cases where they put all the checks in a drawer and lock it. What you want to do is really have a list, have a committee in your company to work on it and go, what's the biggest one, and have a strategy for them. For instance, you might have your biggest vendor, you owe $1.5 million and you've dual sourced that item. So you can just work with the other vendor and work out a payment plan or put on hold that first vendor. Other vendors you can't go a week, like UPS or FedEx will cut you off. So it's important to manage them vendor by vendor. And this is something that is going to be important if it goes to bankruptcy, and to show the lenders that, each dollar that goes out below them, they consider it wants to be an investment that actually improves their collateral situation.
Yeah, thank you, Tom. Yeah, that's very true. So now it looks like the company can make it. It's still tight, but I want to show one more opportunity. And this is really for a product or a service business. This applies. Now we don't need to rely on any inventory. And it's about flow through a business. Any continuous improvement expert look at your flow lines, or value streams, as we call it. And we look at any period of time for any resource, like you see on the lower right here. What is the value added items that got produced, and what is non-value added? Now, most people, say you take a group of legal people, a resource set, and you look at them for 8 hours, and you put this in front of them. They will all say, oh, everything we did was value added. But if you ask their controller, the controller says, no, the client doesn't pay for that, and that. Only the items that the client pay for at the realistic time for what that should have taken is considered value added. And once you can get agreement in a company on what is truly value added, even in a product company. So if a machine produces a part and that quality is spot on, the operator will say, that's a value added time. I've helped the company, but not if that part is not going to be used for 3 months, if there's no immediate market demand for it. So there's a lot of things to consider in value added versus non-value added judgments. But once you can start that conversation in any company, you can start first of all, this is a very unpopular discussion to have, because what you're really asking people to do is to do more work with the same people. And if you do it in the wrong way, you see it in the media often, where a leader gets really scrutinized by the media and by the people for doing it the wrong way. But if you do it the right way is put a metric in place that makes it visible to everyone. So agree on what's green and what is red, and then put that metric in place daily or weekly, whatever you can. Then look at your best person or your best group. And that person, then you make that very visible. Look at Peter or John. They achieved 80% value added last week. And then the underperformers will see, wow, I'm not even doing half of what that other person is doing. And then you can start getting the performance to change and the behavior of people to change. And it happens very fast. So we create competition with this, different machine centers competing with each other, or different departments in a legal firm competing with each other, or even different locations, Chicago competing with Tampa Bay, and those type of competitions we often have, and we put incentives behind it. But to put this into our model is a little bit harder. I just want to explain, this is a busy sheet again, but a lean practitioner uses this. It's called standard time. It's got a Japanese origin, and in this case, it is the setup time of a machine. That in this case, we took a Kaizen team. That's just a group of people that investigate an opportunity. In this case, the setup time. So they have video recorded this, and they have marked green and red what they consider to be value added and non-value added. And then they will do another video session and come up with a plan to do it in a shorter time. So in this case, this team was able to reduce a setup from 38 minutes to 11 minutes. And that can make a big amount of difference in the throughput of a company, especially if it's a bottleneck of that company.
Just to add to that, Kobus, this video he has on this Kaizen and its theory of constraint stuff, it really helps also like professionals, like investment bankers like myself, but lawyers. One thing after watching it really showed how detrimental it is to go to try to multitask or do one project for 30 minutes, stop, do another project for 20 minutes, go back to that project. And it shows how much efficiency you get by just taking a project and just kind of getting it done without any interruptions. And also how, and this is, I'm sure all your lawyers, for instance, on your billing or whatever it is, where you say, okay, this project's due on the 30th day. So you're guaranteed that it's going to take 30 days. And it shows how if you can kind of instead like say, this has got to be done in 3 days, you're going to get it done in 3 days. And so this video is actually this technique that really was first designed for manufacturers. And you can read about it if you haven't read the book, The Goal. One of the best business books and most easy to read business books of all time by L.A. Goldblatt, that Kobus is a big practitioner of this theory of constraints. Highly recommend it. Really easy. It talks about a stress manager and like taking a troop of Boy Scouts on a hike and different things. But it's something that even for most of you who have been practicing law 20 to 40 years, this will be worthwhile.
Right. Thank you for that, Tom. So to put this in our model, we have in the past, we did this on a printer on the West Coast. We have reduced their output through their printers, their value added versus non-value added. We doubled it, which was huge. Once that improvement hit the income statement, it is just a different company. They went from minus 10% profit to plus 10% net profit, which just took them to out of their cash flow hole altogether. So we are just now going to assume a very small percentage. 2% per week is what we're going to project in the model, just to give you an idea of how do we look at this. So we go to opportunity 5, there you see your 2%, and you can easily make it 4 and the numbers will change, but we keep it at 2. And now you see the trick here. The trick here is every 2 weeks, this coincides with the payroll cycle, because you don't take this opportunity to the bottom line without getting rid of people. And that is just one of those realities of life. But in a turnaround situation, you are normally, in this case, we have 2 rounds of layoffs. And as you do those layoffs, the first one we saw is 50 people from each plant. We can't increase that, so that's probably going to happen. You do that on week 1. But the second one in week 10, you have a long time to train people and to see what really can be done with this group of people, so that you can change the number of your second round of layoffs. And this can make a big difference, because you are changing those parameters as you are doing this. So the number here is 959, and I just want to take this off. I'm going to take the accounts payable that I push out off, keep this one in, and show that in the model. And now we are showing cash flow positive. We're starting to make good money, but our borrowing base is not going to look good. So we still have to have this 80% accounts payable push out. And together with these two, you see it works. Now you can, and the reality is you're going to be pushing out as much accounts receivable as you need to. Here you see we are $1 million positive on our availability all the time. And if we move this back to 70%, now it's still, move it to 65. That's going to be the threshold. Here you're going to the negative. So in practice, you are moving out accounts payable based on your availability. That's what the turnaround practitioner will be doing. But now he's doing it smart. He's making deals with the vendors as he has to. And the next slide, I'm going to show you how we put this all together on the timeline. So we started with a PPP loan in week 2. We passed our price increases. We had our first and second layoffs. Then we start draining inventory. Say we do it really fast in week 1. Now, the workload of the people, this is a surprise to companies. The shop floor becomes very quiet, because all of the activity that people used to run the machines to build inventory, that behavior is gone now. We are only allowing people to run a machine if that part is absolutely required for an immediate shipment. And because of that, there's a long period of very low workload until it picks up again. So we use that time for multifunctional training. So what we will be doing is we put Kaizen teams together, and we make them practice on a setup time. So they will go to a machine, they will video record the one operator, and they just do setup times. And in an investment bank, you can do the same with an assessment. You can say, here's the numbers, see how fast you can generate the 13-week cash flow. And you make that a standard work item, so that it's almost like a Ferrari coming into a pit stop, and those crews taking the tire off and putting it back on in 9 seconds. That's the behavior you're trying to create, and you are just making the team feel really competent about their ability to start and stop and have good reaction times to standard work. And at the same time that you're doing all of that, you're doing sales so that you can improve your market share of your company. Now you're telling your salespeople, we have good on-time delivery and better pricing because of all of these improvements, and they are going out and trying to win market share for the company. And then it works. And here's the overall impact of what we discussed today. We started a little bit in the red, minus 1.9 million. external environment put us 10 million in the hole. The PPP hole helped us get back. The price increase helped us get back a little. The layoffs helped us a bit. The inventory reduction was a huge help. And then the flow improvement gave us the rest of the help so that we are now comfortable. And we often talk to companies and say, why do you need a crisis to make all of this happen? See how quickly you could improve? So first of all, don't waste the crisis. If a crisis happens, your advice to a company is use this crisis to really improve. See how you can challenge your teams to rethink the way they're doing things. But also in a more stable environment, do it before the crisis starts, because this means all of this opportunity was available before as well. And here are some quick tests so that you can take away from this. We're running a little bit low on time, but I want to mention on the last one, this one I'm a little bit sarcastic here. A lot of clients may tell us, oh, we are world-class already, and you may hear it as well. Ask the questions of, are you using value-added time, or are you using standard times? Or those type of questions often gets behind these defense mechanisms so that you can see what's really going on. But a good question is also, how often do you do price increases? What did you pass last year? I'm just getting a feel of the type of opportunities that the company is already utilizing. And then here are some value drivers that will remind you of how you can make this benefit your company or your firm. So I want to open it for some questions, if there are questions or any comments. Robert in Australia or Leo from Finland, if there are anything you wanted to quickly add. We may hear from them a bit later. Any questions from anyone else?
Well, I do want to add that Kobus and myself are available to any of you. We're glad to help. This is complicated stuff. It went really fast. But, we're glad to help because it also, it's very important, that you can see the importance of the cash flow, but it's hard just from this one seminar. So we're glad to be a resource to you with any questions about it or how to set it up. But we really appreciate everybody's attendance today. And Kobus, congratulations. You did an outstanding job.
No, thank you, Tom. I appreciate that. And yes, we want to share this knowledge, and that's why we're working with the Turnaround Management Association to get this as one of the offerings, because when a company is in trouble, they need their professionals to really show them all of the options available. That will make all of us more relevant and just make us a stronger community. So we are passionate about that, and I thank you again for the opportunity. We're going to send out a quick survey straight after this call, 4 very quick questions. If you could give us your feedback of how this session went for you, if it met your expectations, we'll really appreciate it. And as Tom said, just reach out if there's any more questions after this session to us.
All right.
Thank you.
Thanks, everybody.
Thank you, everyone.
Great job, Kobus. I don't know how everybody hung through the whole thing, so great job. Congratulations.
Thanks very much. Thank you, Larry. I appreciate it.
Amy, I'll see you for cocktails. Bye-bye.
Bye.